Welcome back to the deep dive. If you've been watching the digital asset space this past week, it probably felt a bit like whiplash, right? Like watching these two massive forces just slam into each other. Absolute price chaos on one side, and then, well, almost flawless performance from the underlying tech. This week, honestly, it felt like the ultimate real-world stress test for the entire crypto ecosystem.
It really was a defining moment. And look, for anyone tracking institutional adoption, tracking the market structure, this period is absolutely critical to understand. So today, we're diving into the top stories from October 6th right through to the 13th. We want to analyze not just the volatility that, grabbed all the headlines,
Yep.
but also the structural growth, the foundation that actually held remarkably strong underneath it all.
Yeah, exactly. Our mission today is to really unpack the true implications of this extreme week. Because here's the incredible paradox we need to start with. Bitcoin first rockets up, hits this absolutely staggering new all-time high, $126,500, just shows incredible acceleration. And then just days later, bam, we see the single largest liquidation event in crypto history, a really brutal, sudden $19 billion flash crash.
And that brings us to the critical question for you, the listener. When the system got hit by a shockwave that big, did the mechanics, did the technology finally buckle, or did the market actually prove its maturity? We'd argue it's the latter, and we're going to show you why.
Okay, let's start with part one then. The extreme swings. That initial surge, I mean, it was incredible. Bitcoin pushing to $126,500 on October 7th, really extending that whole October rally we saw building. What kind of force, what kind of momentum does it take to push an asset into six figures that fast?
Well, that momentum was almost entirely fueled by institutional cash inflows. The traditional finance world, TradFi as we call it, has been allocating heavily, and that created a pretty overheated market. The high leverage that kind of built up on top of all that momentum, it wasn't really a problem until the outside world threw a wrench in the works.
Right, the intervention. And that's what brought us the crash. Over $19 billion in leveraged positions just gone, wiped out in a single day. So was this like a big whale dumping? Or maybe a flaw somewhere, a major protocol bug?
That's what's so fascinating here. The trigger was purely macro, external. It actually had nothing to do with Bitcoin's tech or its fundamentals. Global markets reacted very sharply, very suddenly to unexpected news about a potential new trade war tariff. And that external macro shock immediately triggered this dramatic risk-off behavior everywhere, equities, commodities, and most aggressively in crypto.
Okay, but wait a second. If Bitcoin is supposed to be this non-correlated asset, digital gold, doesn't that kind of reaction to a global tariff discussion sort of undermine that whole idea?
That's a fair point, a fair challenge. What it really shows is that while the long-term structural demand might be non-correlated, in the short term, Bitcoin is now so integrated into TradFi risk models that when global panic hits, leveraged players treat it just like any other high beta risk asset. Sell first, ask questions later. So the external shock created this internal liquidation cascade. Bitcoin dropped fast from that $120,000 range down below $113,000. And that triggered billions in automatic margin calls across all the exchanges. It was the leverage collapsing, not the core system.
Okay, so the structural collapse, painful for traders caught in it, but it actually leads us perfectly to the real story here, which is part two. Decentralized resilience under stress, because while the price was absolutely melting down, the underlying technology, the DeFi infrastructure, it was just working exactly as designed.
Absolutely. And you have to remember, traditional finance institutions, they watch these moments incredibly closely. They need to know with certainty that if their, say, $100 million position needs to be liquidated right now, the system can actually handle it without freezing up or failing.
And it handled it flawlessly. I mean, we've seen centralized exchanges sometimes struggle with these kinds of extreme volume spikes in the past, right? But the core infrastructure of DeFi, we're talking major lending protocols like Aave, decentralized trading platforms like Uniswap, they operated without a single second of downtime.
And this is really where the speed and power of decentralized automation shines. Take Aave. It's the largest non-custodial lending protocol out there. It automatically liquidated a record $180 million worth of collateral in just 1 hour. Now, try to put that in perspective. Imagine a traditional bank trying to process $180 million in complex defaults in 60 minutes. making sure all the accounts are reconciled, the collateral sold at the right market price.
That speed, that processing power, it just highlights the scale of the technological leap we're actually witnessing here, the sheer robustness of these decentralized automated systems under, I mean, literal extreme stress. That's the true silver lining of this whole crash.
Exactly. The fact that these liquidations were transparent, they were automatic, completed without any human intervention or systemic delay, that is precisely the kind of stress test institutional players are looking for.
Yeah.
It proves DeFi can manage these huge, sudden default events efficiently. Basically, it passed with flying colors. And that affirms the risk models of the major banks who are now, actively entering this space.
Right. And that structural resilience, that proof point, gives institutions the confidence to stay put, maybe even double down. Which brings us nicely to part 3. Institutional demand is outpacing supply. Because despite that massive $19 billion wipeout for leveraged traders, the big money, the institutional players, they didn't retreat.
They didn't even blink. Because they are focused on the long game here, the structural imbalance in the market. What's truly fascinating, if you look at the data, is the sheer escalating supply squeeze we are witnessing. We analyzed the acquisitions by institutional vehicles, think exchange-traded products, ETPs, and public company treasuries holding Bitcoin. Collectively, just these vehicles have acquired roughly 7.4 times more Bitcoin in 2025 than the total amount of new BTC actually mined during that same period.
Whoa, okay. 7.4 times. That is staggering. If institutions are soaking up supply at that rate, what does that even imply for long-term price and for, miner viability?
Well, it implies that the asset is becoming structurally scarce. Regardless of short-term price swings, short-term volatility kind of becomes noise when your core demand signal is 7.4 times the new available supply.
Yeah.
And this scarcity is exactly what's driving major financial institutions to formally endorse the asset class. Take Morgan Stanley, for instance. They just updated their guidance for clients.
Oh, really? What's their new take? What kind of allocation are they suggesting now?
They are now formally advising clients to allocate between 2% and 4% of their investment portfolios to Bitcoin and other digital assets. And this move, it isn't based on speculation or hype. It's based on risk-adjusted returns analysis. It officially solidifies crypto's status as a recognized strategic holding within major TradFi portfolios.
Okay, wow. And speaking of bridging TradFi in the decentralized world, S&P Dow Jones Indices just launched something called the S&P Digital Markets 50.
Yes, this is quite significant. It's a sophisticated new benchmark. It combines cryptocurrencies with traditional listed companies that are active in the crypto sector, a sort of hybrid index.
But the really game-changing part, especially for the Web3 world I focus on, is that this index is going to be tracked by on-chain tokens. They're calling them D-shares. Can you help us understand the significance here? S&P, a pillar of traditional finance, taking regulated data and putting it directly onto the blockchain?
The significance is immense. Look, until now, getting high-quality, regulated financial data like an official S&P index value reliably into the DeFi ecosystem has been, frankly, quite cumbersome. By issuing these D-shares, S&P is essentially creating a direct, trusted bridge. It allows permissionless DeFi protocols, smart contracts, to utilize regulated, verified financial data directly in their operations. This really is the official convergence of regulated TradFi data with automated, decentralized infrastructure. It's a huge step.
That integration, yes. That is exactly the kind of structural growth, the foundational building that we're looking for. Okay, let's shift gears slightly to part 4. Because all this institutional confidence, this technical proof, it seems to be forcing the regulatory world to finally pivot, to move towards providing more certainty.
And this pivot is absolutely crucial for innovation, especially domestically here in the U.S. SEC Chair Paul Atkins recently announced the agency is prioritizing the creation of a formal innovation exemption rulebook.
Okay, an innovation exemption. What does that actually do for the companies out there trying to build new blockchain services?
Well, historically, regulators often tried to apply old rules, sometimes decades old, to completely new technology. And that often led to enforcement actions instead of clear guidelines up front. It stifled things. This innovation exemption rulebook is designed to change that, to provide clear regulatory certainty, some legal breathing room. Essentially, it gives builders a clearer roadmap, allowing them to innovate domestically without that constant fear of being told their new service is suddenly illegal 6 months after launch. It aims to stabilize the playing field.
That makes sense. And this push for clarity isn't just a U.S. story, right? Across the Atlantic, in the U.K., the Financial Conduct Authority, the FCA, they officially lifted their ban on selling crypto exchange-traded notes, ETNs, to retail investors.
That's right. An ETN, for listeners, is similar in function to an ETF. but it's structured as an unsecured debt instrument tied to the underlying asset, like Bitcoin. Lifting this ban immediately opens up a massive new, regulated market for digital assets in the UK and potentially wider Europe. It provides a safer, regulated access point for millions of retail investors.
And we're also seeing established players here use this regulatory shift to sort of deepen their traditional financial footprint. Look at Coinbase. They confirmed they're moving forward with their application for an OCC federal trust charter.
Yes, and this is a major structural move. The Office of the Comptroller of the Currency, the OCC, is the primary regulator supervising national banks in the U.S. If Coinbase gets approved for this federal trust charter, it would essentially allow them to operate much more like a regulated U.S. bank, specifically focused on digital assets. This could let them significantly expand services into areas like payments, maybe even full-fledged banking, all within the established U.S. financial framework. It's integration at the deepest level.
Okay, finally, let's quickly touch on part 5,
Yeah.
which is this emerging shift in political leverage. All this adoption, the regulatory movement, it seems to be finally translating into organized political power for the crypto community.
That's absolutely right.
Yeah.
A new survey just came out highlighting the growing political influence here. It found that 64% of cryptocurrency investors now consider a political candidate's stance on digital assets to be a very important factor when they're deciding who to vote for.
64%. That's not a niche group anymore. That's a significant voting bloc. It establishes the crypto community as a serious, organized political force. It basically means that candidates, regardless of their party, are going to have to actually formulate and articulate a clear policy position on digital assets if they want to court this demographic.
Exactly. It shifts the conversation from being just about a niche technology interest to being about a serious demographic force that could genuinely influence election outcomes.
Wow. Okay, so that brings us pretty much to the end of a truly wild week. A week where the crypto market really tested its limits. We saw that extreme volatility, yes, but the enduring story, the one that seems more important, is the strength beneath the surface. You have the proven structural robustness of DeFi and this unwavering institutional demand that's now incredibly consuming supply at 7.4 times the rate it's being mined.
Absolutely. These long-term signals, the SEC planning a formal innovation exemption, the UK opening up retail ETN access, S&P bridging regulated data directly into DeFi, these things overwhelmingly overshadow any short-term liquidation event. You could argue the volatility actually validated the system's strength. It certainly didn't break it.
I agree. These structural indicators, they tell us far more about the future direction of this asset class than the daily, sometimes crazy price swings. So we now seem to have growing institutional clarity, and we have a powerful, organized voting bloc emerging. The question then, for you, the listener, to think about is this. What really stands out to you about the political leverage the crypto community now seems to possess? And how might that leverage be used to ensure this new regulatory framework, like the SEC's innovation exemption, gets implemented effectively and rapidly, ensuring the U.S. stays competitive in this new digital economy?
That's an excellent thought to chew on as you start your week. Thank you, everyone, for tuning into the deep dive.
Yeah, thanks for joining us. And be sure to check the show notes. We'll have links with more details on that Coinbase federal charter application and a fuller analysis of the mechanics behind that $19 billion crash. Until next time, stay secure and keep your eyes focused on the long game.